Welcome back to Living Local. As the end of 2019 is fast approaching, now is the time to make moves that can have a significant impact on the tax you pay in 2020. Today we're out and about here at Schuster Co PC in DeWitt to get some expert tax tips. I'm joined by Carol Schuster, CPA here at Schuster Co PC. Carol, thanks so much for letting us stop by.
Well, thank you.
So before we get to the tax tips, can you tell us about the history of Schuster Co PC?
Well, actually, this office was part of a national firm, and I was a partner in that firm. And I retired as a partner, and they sold the practice location to me. So all the staff that was here then continued with me, and they're even here today. That was October 1 of 2008. So it's been 11 years ago.
It's great to have that consistency with the staff, I'm sure. So now for the tax hacks. First of all, what materials will people need to gather when projecting their year-end income and deductions?
Basically, you're doing the same thing as you would do for your tax return. You are gathering your income and your expenses. The only thing is you don't have the notorious January mail when you get your W-2s and 1099s, that information. But if you're a business or a farm, there's a lot of other information you need to be gathering. So it's a good time to start getting everything put together.
Definitely. Get organized now.
Yep.
What does the term defer income mean, and who does that apply to?
Well, it applies to everybody. Deferring income is you're moving income from this year into next year. And you're doing that because you're not paying tax on it then, so you're saving money. The kinds of income you can defer: if you're a self-employed business, don't do your billings. Wait until the end of December so the income won't come in until January. So that's one way to defer. Some people defer their year-end bonuses into the next year. Let's see, so a wage earner, because they don't have a lot of opportunity to defer income, that's really the only thing they can defer.
All right, important points there. Now, what are some examples of some last-minute tax deductions for people out there?
Okay, a last-minute tax deduction are things that you can do now that will save you tax. You can do charitable contributions, and one of the things with charitable contributions, you can give away appreciated stock. And the value of appreciated stock is that if you bought a share of stock for $20 and it's worth $150 now, and if you gave away that stock, you'd have a $150 deduction, not $20. And also there's $130 gain there. You won't be reporting the tax on that gain either. You just take the deduction.
Okay, some important tips there. There's a term called loss harvesting. What does that mean?
It's an interesting term,
yeah,
isn't it?
It is. I love it. Farm girls ourselves, harvesting.
Yes, harvesting. Generally, that's with your stock holdings. And what you'll do is if you have had gains during the year, at the end of the year, you look at those gains and you have your stockbroker go through your portfolio and see if he can harvest some losses. So he'll be looking for stocks that have lost value, and he'll sell those. So what happens then is you have those losses to offset your capital gains. Capital losses will offset capital gains, and you can deduct $3,000 of losses against ordinary income. Otherwise, it just stays with the capital gains.
Right. Now, when it comes to retirement accounts, why is it so important to contribute the maximum amount?
Our tax system is a graduated scale. So as your income rises, your percentage of tax rises. So, income's going up, 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 and the tax doesn't stay level, but it gets bigger as you get more. So if you do a retirement plan, you're taking off that top level and you're saving tax at a higher rate.
Gotcha. That's such an important point to make. Now, can you explain required minimum distribution? Lots of terms we're unpacking today.
RMDs.
Yes.
The RMD, required minimum distribution, if you have a retirement plan or an IRA, once you hit that magic age of 70 and a half, you need to start withdrawing your RMDs. And the reason for that is there's a large penalty it's a 50% excise tax if you do not take your required minimum distribution. So if you were supposed to take $4,000, your tax is going to be $2,000. That's a lot.
Right, yes, absolutely. Now, Carol, are there any new tax laws that are important for people to understand?
In 2018, there was a large tax law passed, the Tax Cuts and Jobs Act. And what I think, there's a lot of things in that act, but one of the provisions that stand out to me is it's a 20% pass-through deduction. So if you have a farm, a business, or a pass-through entity, and a pass-through entity is if you're a member of a partnership, sub-S corporation, an LLC, those entities file tax returns, but they do not pay tax. They pass through their income to the individual, and he pays the tax on his individual return.
Okay.
So that's how it gets the term pass-through entity. If you made $100,000 of profits in one of those entities, the new bill gives you a 20% deduction. So you can deduct $20,000 of income off that $100,000. If you're in a 22% tax bracket, that's a $4,400 tax savings. Major. Very
major. Carol, we've covered a lot of stuff today. If people out there are wanting some more one-on-one guidance with their taxes, how can Schuster Co PC help?
Call us. We are here to serve, and we like to help people save tax. So, and it's not too late. It's good to have some planning done before the end of the year, and that's December 31st.
Right,
and then we're done.
Yep, that's right. Well, Carol, thank you so much for your time today and for all the advice.
Thank you.
All right, you guys, Schuster Co PC is located at 1015 6th Avenue in DeWitt. For more information, you visit schustercpas.com. More Living Local returns after this. Stay with us.